In this lesson, we're going to consider the impact of risk in financial markets, how to model it, how to think about people's reaction to it, and really how to deal with it in practice. I want to think about this maybe to begin with kind of a little multiple choice just to test your thinking, and then hopefully by the end of the lesson we'll be able to get a better answer to the question. But suppose there was a bond, maybe a zero coupon bond, whatever it happens to be, called Bond 1, and suppose that's more risky than Bond 2. Then, compared with Bond 2, it will generally have, and you name it, a higher yield, maybe, a higher price, maybe, lower yield, similar price, similar yield. So Bond 1 is more risky than Bond 2, and you have to ask whether it is its yield, or its price, or whatever it happens to be, is different as a result. So think about what your answer would be, write it down on a piece of paper, and by the end of this lesson, you should be able to get the right answer. How are we going to do this? How does risk affect the pricing of financial assets? We want to bring in our basic ideas of economics to answer this question. We're going to assume that people don't like risk. They're risk averse, is the technical term economists use. So if they are going to make an investment which is risky, they're not going to like that. They'd rather have a safer investment. Now that might seem a little strange if you think about the fact that a lot of people like to gamble, they kind of like risk, they maybe like to go to casino, they might put some money in the lottery. And that's true. People do like to gamble, they do like to take a little risk. But usually, for most people, for relatively small sums, compared to the amounts they may be investing or compared to the amounts that of their income. Almost all people become risk averse when the numbers are big. And so we're going to make that assumption that people are risk averse when it comes to fairly large amounts of money. Second, we want to apply this central idea of economics, the mantra, that people make purposeful choices when they have scarcity of one kind and another. In this case, we're going to consider the choice not between apples and oranges, not between bananas and grapes, not between toys and jewelry, but between more risky assets and less risky assets. So there's going to be a risky choice and a non-risky choice. That's our pairwise comparison that we're going to be used to analyze the impact of risk on people's behavior. The two choices, therefore, to be very specific, are going to be represented in this chart. Let's start over on the right. The choice is a bank account, which is listed there, compared to, on the left, what's going to be a corporate bond issued by a firm like General Motors. The bank account is going to be the safe investment. You're going to get a rate of return at this bank account, could be for a year, of 4%. In all three cases. Case 1, you get 4%. Case 2, you get 4%. Case 3, you get 4%. Put $100 in the bank, you get $4 in interest. If you take the money out at the end of the year, you get $104. Over on the left is the bond. So the bond is going to have a price change in it. So there's going to be some uncertainty about the bond. It's not going to be a sure thing. It's going to depend on how much the price of the bond changes during the period under consideration. So that means there's going to be some uncertainty. And the uncertainty is illustrated in these three cases. So case 1, the alternative rates of return are either minus 2%, you lose something, or 10%, you do pretty well. And the minus 2 and 10, if you look at it carefully, has sort of an average. The in-between point of those two is 4. Okay, it turns out it's the same as the rate of return of the bank, 4. And the minus 2 is 4 minus 6. The 10 is 4 plus 6. So effectively, you're looking here in case 1 of a rate of return that's 4 plus or minus 6, 4 plus or minus 6. And that plus or minus 6 represents the uncertainty, the risk that's associated with that kind of investment, a corporate bond in this case. And note that the average, or what economists call the expected return, is 4%. And that's under the assumption that you're going to get minus 6 with, say, 50% chance and plus 6 with 50% chance. So the 4 is kind of in the middle, and economists call that 4, therefore, the expected rate of return. But You might get -2, you might get 10. 4 is kind of just the in-between point. Case 2 is set up a little differently. It has a situation where you get 2% or 14%, so the numbers are higher. It's actually, they've added 4% to what you get in case 1. And so now you basically have 8 minus 6 or 8 plus 6. Your rate of return is 8 plus or minus 6. So the expected rate of return is 8, and that's higher, of course, than case 2 in the bank, which you got 4%. And then the third thing is to look at is even a higher return, so it's 3% or 15%. And this one is 9% plus or minus 6. So case 1, case 2, case 3 have the same amount of risk, always plus or minus 6, the same amount of spread, but they have higher expected returns. 4 in case 1, 8 in case 2, 9 in case 3. Now think about this idea we had that people are risk averse. Suppose that we are in the world of case 1, and the consumer, the investor, has to choose between the corporate bond and the bank account, and case 1 is the situation. Well, if this is a risk-averse person, which we're assuming, there's no way they're going to choose the bond, because they get a 4% return from the bank account, where they have this great deal of uncertainty in the case of the bond. On average, or in expected sense, they get 4% for that bond. But they're going to go from -2 to 10. So there's a considerable amount of risk there. And so our reasoning would say they would not choose the corporate bond in this case. They would choose the bank account. They would go to the safer one. Now consider case 2. Well, case 2 is equally uncertain, plus or minus 6. But 8 is quite a bit larger than 4. So in this case, if you buy the corporate bond, you take that extra risk compared to the bank, but you're getting compensated for it in an important sense. That 8, which is in the middle of 2 and 14, is higher than the 4. So that extra expected return is compensating you for taking that extra risk. For some people, that might not be enough. They're really risk averse. They say, yeah, well, I still like to take the bank loan because it's safer, and I know the return is higher in case 2 on average, but I can still go to the bank. So more risk-averse people might have to have a higher return. Maybe that's case 3. In case 3, it's still the amount of uncertainty, minus 6 plus 6 is the same, but now they're getting this higher number, 9 on average, or the range from 3 to 15. So at some point, risk aversion will, even with risk aversion, you'll make the choice on the more risky asset if you're compensated enough for it. So that's the basic idea that's being illustrated here. If there's risk, and if people are risk averse, they're going to want some extra expected return. They're going to want some extra compensation from taking that risk. It's illustrated in this particular picture. Does it work in practice? Well, we have a very particular prediction from this. Just review it again. Risk averse people are willing, they should be willing, according to our reasoning, to take on risk if they are paid for it. And so this has implications for the prices on the market. We want to see the implications of this risk for prices on the market. And in particular, we should find that more risky assets should have a higher expected rate of return. That's what people require to hold those risky assets, a higher rate of return. And we'd like to hope that this theory works in practice. Indeed it does, but let's sort of see that in practice. This is a way to think about how this would work in a market. So you now want to have a market where there are a lot of people that are risk averse, and if this reasoning is correct, there should be a relationship between risk and the return, expected return on any given security, whether it's a bond or whatever it happens to be, and this line is supposed to illustrate that. And to apply our reasoning to a market, which you're seeing here, let's think about it logically by considering some alternatives. So suppose there's a security or an asset which has the risk labeled at A and the return labeled at A. And then there's an alternative one, which is B. That has the same expected return, but it's more risky. We would think if people are risk averse, they would not like to have B. They'd rather have A, so they would try to dump B, get rid of it. It's much better to get A instead. Or you can consider another point, C. Now, C has the same expected return as point D, but it's less risky than the security at D. So logic would tell you that people would try to sell B and buy C. You buy C, it's attractive. Its risk is lower than D, but its rate of return is the same. And that's indeed what will happen. So the people should probably try to sell B. If B is a bond, they'll try to sell it. And as they sell it, the price will be bid down. That's what happens in a market. If people try to sell something, the prices will fall. But we know there's inverse relationship between the price and the return on the yield, okay, expected return. And so what should happen, therefore, is the return should go up as the price goes down. And that brings this security up towards the red line, which is what the theory should predict. The same thing in reverse happens for C. In this case, people would like to buy it, and so that will drive the price up and the yield down, or the return down. And you can see it brings it back towards the line. So we have now not only a theory of individuals, but a theory of how the market will work as people try to buy and sell securities to bring the risk-return trade-off on the line, on this upward sloping line. Higher risk is going to be higher return, according to the theory. Let's look a little sort of an empirical example of this to see how well it works. This is a situation where you are looking at two different interest rates, two different yields on two different types of bonds. The blue one is bonds issued by the United States government, U.S. Treasury bonds. The red one is the yield on corporate bonds, business firms. Since the U.S. government doesn't default, and some firms do, it's less risky. So the U.S. government investment is less risky, and so lo and behold, we have the yield or the return lower in the picture, the vertical axis measuring the yield or the return from those securities. So the red line is higher than the blue. That's evidence that this theory is working. You also see a very interesting increase in the spread between those two during the financial crisis in 2008. The yield on corporate securities jumps up quite a bit as people become worried that those securities will not be honored. The firms will go bankrupt, or there'll have to be a default on the debt. They wouldn't pay the money back, and so that raises the risk, and people need to be compensated for that, and the yield is higher. Treasuries are kind of the opposite. That dips down in the financial crisis because they're viewed as even safer compared to other assets, and so people basically willing to take a smaller yield, a smaller expected return. So the theory works quite well in practice, as these numbers indicate. Now what I'd like to do is consider other kinds of securities besides bonds. We'll do that in the next lesson.